Hello everyone, and thank you for being with us today. First of all, so I'm Nicolas Suiffet from Training Central. First of all, I would like to make a check with the sound. Can you confirm that you hear me well? So if you can just send a small message in the box so I can check if the sound is okay, and then we can start. Okay, perfect. Okay, so great. So we can start. So thank you for being here with today, and thank you for Orbex to have organized this webinar on technical analysis. So the purpose today will be to help you to better understand the financial markets and to better understand how you can use technical analysis in your investment strategies. So I will assume that you are familiar with the basic principle of technical analysis. I mean, I will assume that you are aware of the basic concept of behind the support and the resistance threshold, behind channel, and all this kind of basic principle. And so today we will speak about a lot of interesting stuff regarding the financial market. So how you can use pattern to fine-tune timing on the market, or the Japanese candlestick. But first of all, let me just to introduce myself first. So I'm Nicolas Suiffet. I'm in charge of the European equity indices research at Training Central. I'm based in Paris, by the way. I graduated from Paris Dauphine University with a master's in financial research, and I'm a member of the Society of Technical Analysts for more than, I think, 8 years. And my job on a day-to-day basis is to provide mathematical approaches from intraday trading to swing trading, and even on long-term investments for institutional and private banks. Yes, and prior to joining Training Central, I worked for a French equity broker, Exane BNP Paribas, as a global macro strategist. So let's see what we will talk about in the forthcoming minutes, in the next half an hour. So first of all, I will say just 2-3 words on the basic concept in technical analysis. So I mean behind trends and volumes, and especially trends. Why? Because that's clearly the cornerstone of technical analysis. Trend is clearly the cornerstone of technical analysis. If you don't believe, to be crystal clear, if you don't believe prices move in trends, we can stop right now this webinar. There is no reason to go ahead. Why? Because the whole purpose of a technical analyst or a trader, an investor, is to identify trends in early stages of their development in order to take position in the direction of that trend. So that's why that's clearly the cornerstone of technical analysis. And we will just say 1 or 2 words about that. And then we will speak briefly, about gaps. Gaps are very important in the financial markets, but to be honest, today we will be more focused on the forex market, and I think this is more what you are expecting at the moment. So the gaps are not doesn't occur so often in the forex market. So that's why I will be quick on this part. I will just give you the basic principle behind the gaps and how to use them, how to recognize the very interesting gap. Then we will speak about Very important part. This is this part regarding the classical technical pattern. So we will see that we have two different types of pattern, the continuation trend pattern and the reversal trend pattern. So this is two different approach, and we will see how to use them. So we will speak, there is a lot of pattern we can recognize on the market. So today we will only focus our attention to the head and shoulders pattern, which is one of the most popular pattern in the market. So this is a reversal trend pattern, and then we will speak about the flag pattern, which is a continuation trend pattern. So we will speak about two of the most interesting pattern in the markets. Then we will say a word on the Japanese candlestick. There is to be honest, a wide range of Japanese candlestick, but we will explain briefly how does it work, and we will try to recognize some patterns in the market at the moment. And finally, we will start explaining how to use mathematical indicators in the financial markets. So today we will focus our attention on the Bollinger Bands and the RSI. You can find these two indicators on the charts we send. So you can find in the newsletter we send on technical analysis, you can see these two technical indicators, so the Bollinger Bands and the RSI. So that's why it's interesting, I think, for you to explain how does it work, how you can read these technical indicators. Of course, if you have questions, you can ask me all the questions that you want, but preferably at the end of the presentation, so I will take time to answer all your questions. So let's start. So let's start with the concept of trend. As I explained, trend is very important in the financial markets and especially in technical analysis. Because as I explained, this is the whole purpose is to identify the trend in early stages of the development. So as you can see, we have three phases of primary trends. You can see on this chart the three phases. You have first the accumulation phase. If you are in a bullish market, you have three stages: the accumulation phase, the public participation phase, and the excess phase. So you can find these three stages on this chart. So the first one, the accumulation phase, is a kind of a trading range very often. Prices are moving up and down with no trend, and it's pretty difficult to do to find interesting trading ideas within this phase. Within the first stage, the accumulation phase, this is pretty difficult to do some recommendation to open some position. The only thing I would advise for if you want to trade a product which is in the accumulation phase, which is in a trading range phases, is to buy the lower end of the range and to sell the upper end of the range. But it's pretty difficult, and clearly, definitely, that's not the best moment to invest for a trader, for an investor. The second part, the participation phase, is clearly more interesting for traders and for investors. Why? Because prices have escaped from the accumulation phase, and now prices are moving in a clear trend. In this case, this is an uptrend. So prices have escaped from this accumulation phase, and now they are moving in an uptrend. You can see that prices are moving in an uptrend thanks to bullish trend line, for example, or thanks to rising moving averages. You have a lot of technical indicators who can help you to identify a trend. So if you are in a bullish trend and if you are in this participation phase, this is the most interesting phase for traders, for investors. Why? Because prices are moving in an uptrend, and you can take advantage of any consolidation within the trend to buy the market. So that's why that's pretty interesting. Prices are moving up slightly and in a healthy up move. So that's pretty easy for traders to buy the dips and to take advantage of the current trend. And finally, the last phase, which is called the excess phase. This one, prices are moving up very quickly. So it's very interesting for you if you are already in the market, if you bought the product or the market within the participation phase, when prices were in participation phase. So in this case, the excess phase is great. You just have to wait to take your profit with a great timing. But if you are not in position, that's pretty difficult and pretty dangerous to buy the market when the market is in the excess phase, because it's pretty difficult to anticipate reversal downtrend. So it will be very difficult to put stop loss, because when you open a position in the market, we always recommend to have a trading plan. A trading plan is a stop loss and a target, at least one target, one, maybe two, or maybe three targets, but you have to put a stop loss. And within the excess phase, it's pretty difficult to put and to find an interesting stop loss. So that's why it's pretty difficult to buy the market when you are in the excess phase. It's better to buy when you are in the participation phase. So let's give you an example of this, or maybe before the example, just a word on the volume. You don't have on the forex market access to the volume data. So I will be brief on this part, but what we can say if you want to invest on the other products, on the other markets, the basic rule is that volume should increase when the price moves in the direction of the trend, and volume should decrease when the price moves in the opposite direction of the trend. So as you can see on this example, you can identify a bullish trend thanks to the price breakout just here. Prices were moving sideways, so you have the accumulation phase. Then you have the price breakout here, and then prices are moving in an uptrend. And regarding volume, just below, you can see that increasing volume when prices make new highs. So in this point, for example, on the prices are accelerating up, and at the same time, volume are increasing. So it means that the uptrend is healthy, and the volume increase when the price is moving up. So that's pretty good. And when prices are posting a consolidation move, for example, within this phase, the volume is decreasing. So here. So that's perfectly normal. And you can say, okay, the market, that's a normal situation in a bullish trend. The volume is increasing when prices are accelerating up, and the volume are decreasing when prices are consolidating, are in consolidation phase. So that's the basic rule. And if volume runs counter to the trend, it is a sign of weakness in the existing trend. It doesn't mean that the price will reverse downward, but this is a warning signal, clearly. So when you can, not on the forex market, but on the other market, on the equity market, for example, don't forget to check the volume. If you want to confirm the trend, volume has to increase when prices are moving up, and volume has to decrease when prices are consolidating. Let me show you before have a look at the gap. I just would like to show you the charts of euro dollar. So you can see on my screen now, on my software, you can see the chart of euro dollar in the last couple of years. So since 2012, around 2012. And I would like to show you the accumulation phase and how long it can last. Have a look at this chart. This is the euro dollar. You can see that the euro dollar was in a bearish trend since 2014. You can see here the huge bearish trend. That's pretty obvious. Very clear, very quickly, and that's clearly a bearish trend. And then between 2015 and 2017, So for more than 2 years, prices have moved in a sideways market, so up and down, with no trend on a weekly basis. So within this phase, there is nothing very interesting to do regarding strategies on a medium-term basis. If you want to invest on euro-dollar within an accumulation phase, all that you can do is to sell the upper end of the range and to buy the lower end of the range. That's the best strategy to adopt within an accumulation phase, within a trading range phase or a sideways market. Or what you can do is to change your horizon of investment and to say, okay, as there is no trend on a weekly basis or on a medium-term basis, I will try to invest on a more short-term period for maybe the next couple of days or the next couple of weeks, and I will try to take advantage of slight movement, slight bullish acceleration or bearish acceleration, but even on an intraday basis or on a or using a swing trading method. But what is very important to notice on this chart and what I wanted to show you is the strong accumulation phase. And then prices have escaped from this accumulation phase. So since July 2017, prices have escaped from this accumulation phase. So now we can say that the euro-dollar is in a bullish trend on a medium-term basis, thanks to the breakout of the sideways market of the trending range. So prices have escaped from this phase. So this is one of the best moments to invest in the euro-dollar. Why? Because we are in a participation phase now on the euro-dollar. So let's go back to the presentation. So let's say a word on gap. So you have 4 types of gap. The first one, this is the common gap. The common gap is this one. So the common gap is pretty useless. Why? Because the common gap occurs within a trending range or within a sideways market, as you can see here. So it doesn't mean anything. It's not very important in the market, and you can forget about it. And be careful. Don't interpret too much a gap if the gap occurs in a trending range market. The risk is that you have a false signal, and it can be a bit dangerous to anticipate something thanks to a gap within a trending range. So the best things to do is to forget about this kind of gap. So this is the first one. This is the common gap, and you can forget about it. The second one is very interesting. This is what we call the breakaway gap. Breakaway gap is very interesting. Why? Because this is a trigger gap. This is very often a trigger point on the market, which is followed by a bullish or a bearish acceleration. As you can see in this chart, the breakaway gap occurred above a trending range phase or a pattern. It helps the prices to confirm or to validate a pattern. It can be either a flag pattern, a triangle pattern, whatever. The idea behind this is that the breakaway gap occurs after a long period of consolidation. And it can be, this consolidation can be, again, either a bullish flag or bearish flag, or a triangle pattern or a wedge pattern, whatever. But this is very interesting for traders because very often, just after a breakaway gap, you can identify a new trend. So prices were in consolidation phase with no trend, and after the breakaway gap, you can identify a new trend. So if it's a bullish breakaway gap, you can identify a bullish trend, and if it's a bearish breakaway gap, you can identify a bearish trend. So in this example, as you can see, prices have accelerated up after the breakaway gap, and regarding the trending strategies, that's very interesting because it helps you to fine-tune timing and it helps you to put your stop loss. You can have a very easy training plan to put thanks to thanks to this gap, with a stop loss set around the bottom of the gap, and you can find some target using the previous consolidation phase. But that's very interesting to use this breakaway gap to enter a position in a market. So as soon as you can identify breakaway gap, that's very often an interesting opportunities in the market. The third gap is the runaway gaps. So this one occurred within the trend, as you can see. The trend is already up, and in the middle of the trend, you can see another bullish acceleration thanks to another bullish gap. And this one is called the runaway gap. It just means that the trend is still valid and the trend will continue. And finally, you have the last one, the exhaustion gap. So this one. And the exhaustion gap occurs at the end of the current trend. So that's pretty difficult, to be honest, to identify the exhaustion gap. But you can say that if you have identified a breakaway gap, if you have identified at least one runaway gap or maybe two runaway gap, you have a high probability that the third or the fourth gap will be the exhaustion gap. And you can use some other technical indicators to help you to identify exhaustion gap. For example, if the exhaustion gap occurred when the market is highly overbought, for example, on technical oscillators, technical indicators such as the RSI, for example, it can help you to anticipate the exhaustion gap and say, okay, there is a high probability that this is an exhaustion gap. Why? Because the market is highly overbought. We have already seen 2 or 3 gaps before this one. So there is a high probability of seeing an exhaustion gap. Or you can also wait for the break below the lower end of the gap, the opening price of the gap. So this point here, when prices fell below the opening price of the gap, you can say that, okay, it confirms that this was an exhaustion gap, and you can close your position and take your profit. Okay, so let's switch to the classical pattern now. So let's start with the head and shoulders. As I explained at the beginning of this webinar, you have 2 types of pattern. The first type is the reversal trend pattern, and the head and shoulders is one of the most popular reversal trend pattern. So why using this kind of pattern? That's quite simple, because when you open a position on the market, as I explained at the beginning, okay, you bought the market at the time, and you have a training plan, and things are doing well. You are making profit, but you don't know how to close your position. When do you have to take your profit? It's pretty difficult to anticipate that. So if you can identify such a pattern, it can help you either to take profit if you are already open a bullish position, or it can also help you to open a counter trend position if the pattern is validated. So let me explain briefly the rules. So as you can see on these charts, you have to see you have 3 rules to validate this pattern. The first rule is that the 2 shoulders should have similar amplitude. So you can see here the left shoulder, you can see here the head, and you can see here the right shoulder. So the 3 rules is that the 2 shoulders, so here and here, should have similar amplitude. And you have to see a balance between the head and the 2 shoulders, and in time and in amplitude. And finally, the neckline. The neckline is this line. This is one of the most important trend line on the chart. Why? Because you will use the neckline to validate the pattern. So as soon as prices are holding above this technical support, this neckline, you cannot say that the pattern is validated and you cannot anticipate the reversal downtrend. But as soon as prices have broken below this trend line, you can say, okay, the pattern is validated. This is a reversal downtrend pattern. So I would better to close my long position, or maybe I would better to open a short sell position. Regarding the targets, we can calculate a theoretical target of this pattern. How? It's pretty simple. You have to calculate the distance between the head of the pattern and the neckline, and you have to report this vertical distance from the breakout point of the pattern, of the neckline. So from here. So as you can see here, you have the vertical distance from the head to the neckline, reported to the breakout point, and you find the target. This is the dotted line in red on these charts. So it's pretty easy to use. Let me show you an example. So this was euro dollar. Let's have a look at the cable. So this is a chart. This is a daily chart of the pound, the British pound against euro, against the dollar. And I wanted to show you this example. Why? Because what I wanted to show you is that sometimes the theoretical target of the pattern is enough. So you can see here the target, the pattern. Sorry, I just tried to, yeah. Okay. So you can see here the bearish trend, and you can see here the inverted head and shoulder pattern. Here. And you can see here the vertical distance from the head and the neckline. And you can see here the theoretical target calculated from the breakout point. You can see also notice that we have a strong bearish trend before the formation of the pattern. And that's very important to keep this in mind. Don't forget the basic rule for a reversal downtrend. If you want to identify a reversal downtrend pattern, such as the head and shoulders pattern, you have to find prices have something to reverse. If there is no trend, you cannot find the head and shoulders. I'm saying that because very often I have clients who are coming back to me saying, hey, have a look at this picture. That's a beautiful head and shoulders pattern. And I say, no, it can't be a head and shoulders because there is no trend on the market at the moment. So there is nothing to reverse. So if prices have nothing to reverse, if there is no trend to reverse, you cannot find head and shoulders. So don't forget about that. You have to identify, first of all, a clear trend, a downtrend. If you want to identify an inverted head and shoulders pattern, such as in this example, or you have to identify a bullish trend if you want to identify a classic head and shoulders pattern. So let's go back to this chart. We have a bearish trend. We have identified an interesting inverted head and shoulders pattern, and we have identified the target. And as you can see, sometimes it's enough because in this example, I wanted to show you that sometimes prices will not go above the theoretical target of the pattern. As you can see, it was time to take profit as prices were approaching from the theoretical target of the inverted head and shoulders pattern. And then prices have resumed their downtrend. So it's a particular case because it was just before the Brexit last year. So that's why I have chosen this example. So keep this in mind. Don't be too greedy on the market and take profit when prices have reached the theoretical target of a pattern, or at least take part of your gains, part of your profit. Let's go back to the presentation. So we have seen the head and shoulders pattern. So now let's have a look at the flag pattern. So we have seen the reversal downtrend pattern, which is very interesting for you if you want to know when you have to close position or to identify trending ideas on the market if you want to open bullish or bearish position. So this is the reversal downtrend pattern. We have another type of pattern which is called the continuation trend pattern. So these patterns are very interesting, not to take profit, but to open new position. The continuation trend pattern are very useful to fine-tune timing, to open position in the direction of the previous trend. So you can see in this example, in this chart, you can see the formation of the flag pattern, which is a kind of a consolidation phase. And before this consolidation phase, you have to identify a strong bullish trend. This is the dotted line in blue. And you can find the target using the flagpole. What is the flagpole? The flagpole is the distance from the first resistance or the support break to the high or low of the flag. So as you can see, this is the arrow here. And you can find the target by reporting the flagpole from the bottom of the consolidation. And you will find the theoretical target, the measure up move target of the pattern, of the bullish flag pattern. So this pattern is very interesting for you to open a position within the market. Not to take profit, but to open new position. The reversal downtrend was very useful to close position or to open position in the opposite direction of the trend. But the continuation trend is very interesting to open new position within the consolidation phase. So for example, you can wait for the breakout of the declining trend line, this one, to open new position in the market. Because the breakout of this trend line will trigger new bullish acceleration. It will give us the signal that the consolidation move is over and that prices may resume their uptrend. So that's very interesting for you. How to identify flag pattern? Let me show you some example. Again, so we have seen the pound. Let's have a look. I think it's not here. Sorry, hold on one sec. Yeah. So you can see on my chart now a very interesting bullish flag pattern. So you can see here in red the bullish flag. So let me explain briefly how does it work. As you can see, prices were capped by this key declining trend line in blue. The upside breakout of this trend line has triggered a bullish acceleration and has validated the bullish trend. So it means that as soon as prices are broken above this trend line, you can consider that prices were in a bullish trend. And then after a bullish trend, as I explained, prices can take a breath within this bullish trend thanks to the formation of a bullish flag here. And the breakout of the declining trend line of the upper end of this bearish channel, the breakout of the upper end of this bearish channel has triggered a bullish acceleration and has given the signal, the bullish signal for investors. And thus it was pretty interesting to open long position thanks to the breakout of the bullish flag pattern, meaning that prices may resume their uptrend. And regarding training plan, you can use the previous bottom of the pattern. So in this case, the previous bottom was set at 122.30 on the Euro GPY. So this is here, as you can see, the bottom of the flag. So you can put your stop loss here. Just after the breakout, you buy. And the target is, as I explained, let me just show you the Fibonacci projection target. So you can calculate the flagpole here, reported to the bottom of the pattern, to here. And you can find here the target. So the target one was 133.25, approximately. So you have an interesting trading plan, as you can see. Prices are in an uptrend. Prices are validating the bullish flag pattern, which is a bullish signal. So a continuation trend pattern. So you can put your stop loss at 122.30 and you can put your target at 133.25. So you can see that you have a pretty interesting risk to reward ratio. So in terms of risk management, that's very interesting for you. Keep in mind that you always have to put your target far away from the stop loss. I mean, if you have risk reward around 2 or 3, that's great. And that's what we recommend to investors. So to be honest, at the moment, I would not buy again the Euro JPY. Why? Because prices have reached the theoretical target of the bullish flag pattern. So prices may have entered into a new consolidation phase. And as soon as prices are within the consolidation phase, I would do nothing. I would wait that prices will draw maybe another bullish flag pattern. That's possible, I don't know, or another pattern, but maybe it can be also a reversal pattern. So at this stage, we don't know. So all that we know is that prices have reached the theoretical target of the bullish flag pattern. So this is a profit-taking area and not a buying area. If prices manage to push to form a new bullish flag pattern, then we will be buyers again. We will buy again the pair. But at the moment, we don't know. We don't have enough information. All that we know is that prices have reached the theoretical target of a bullish flag pattern. So it is much more a profit-taking area rather than a buying area. So that's why that's very interesting when you have a look at the chart to calculate the theoretical target of the pattern you can see on this chart. It can help you to fine-tune timing and not buying the market when it's overbought or not buying the market when people are taking profit. Okay, so this was the example for the flag pattern. Let's now switch to the Japanese candlestick pattern. So there is a lot of things to say on the Japanese candlestick pattern. This is a very wide theory. You have a lot of different Japanese candlestick pattern. The basic principle is that candlestick charts is that the Japanese candlestick are more visually appealing and easier to interpret. As you can see here, that's the first interest of the Japanese candlestick for traders. When you have a look at the chart, it's clearly more appealing, visually appealing, and more easier to interpret. So that's the first good point for the Japanese candlestick, I would say. But that's not enough. The other part is that the Japanese candlestick can consist of a single candlestick line or be a combination of multiple lines between 1 and 5 candle. And you can anticipate a trend reversal thanks to the formation of Japanese candlestick pattern. So this is another very interesting thing and another very interesting way to use the Japanese candlestick when you are able to identify the formation of pattern. So how does it work? This is a candlestick. You can see here. So you can see the body, what we call the body, the real body here. So the body is the difference between the open and close. So here and here. So if when the close is higher than the open, the body will be green or white. It depends on the software, on your software. And when the close is lower than the open, then the candle, the body will be black or red. Again, it depends on your software. And you have also what we call the upper shadow. You can see here, and the lower shadow here. So the upper shadow is the vertical line between the high of the day and the close, or the open. And the lower shadow is the opposite. So it can help you to identify very quickly the high of the day, the low of the day, and where was the opening price of the day and where was the closing price of the day. So that's why we use this kind of Japanese candlestick. And then, as I explained, you have some specific candlestick. So the doji is a very specific candlestick. So a doji forms when a securities open and close are virtually equal. So you can see here, the opening price and the closing price are the same. So you can see just a line. And this pattern, the doji candlestick, is when it appears in an extreme point, it often suggests a reversal of the trend. So that's why it's pretty interesting to identify doji on the charts, on your charts. When you can identify a doji on your chart and when it appeared, when it occurred in an extreme point of the trend, for example, if the market is very overbought and you can identify a doji, it means that you have a high probability of a reversal downtrend. And on the contrary, if the market is very oversold and you can identify a doji, it means that you have a high probability of a technical rebound, a reversal uptrend. So that's very interesting to try to identify dojis on your charts on the market. And then you have the pattern. So the pattern, as I explained, is the formation of several candlesticks between 2 and 5 candlesticks. And you can identify a lot of patterns. So here is one of the most popular pattern, which is called the Morningstar pattern. So what's the rule for this pattern? So first of all, you have to see an early, so this pattern is used to identify reversal uptrend. So the rule is that the first bar is a large black or red candlestick located within a defined downtrend. So don't forget about this. This is the same rule that for the pattern, the head and shoulders pattern or the bullish flag pattern. As I explained, if you want to identify a Morningstar pattern, previously you have to identify a downtrend. So before the formation of the pattern, the Morningstar, you have to identify the downtrend. If you are in a downtrend and you can identify a Morningstar, then you have a high probability of a reversal uptrend. But don't forget to check that we are not in a sideways market or we are not even on a bullish market. That will make no sense to identify a Morningstar pattern if you are in a bullish trend. So if you are in a bearish trend and you can identify a first bar, which is a large black or red candlestick, then the second one is a small body candle. So as you can see, the body of this candle is small in comparison to the previous one. This one is a very large body with a small shadow, higher shadow and lower shadow. And this one is a black or white body, but with a small body. That's what's very important. And also the highest point of the body has to be lower than the closing price of the previous candle. So this level here has to be lower than this level. So the previous close, the close of the previous candle has to be higher than this closing price of the second candlestick. And then the last one, the last candlestick, which will give you the bullish signal, is a large white candlestick, a large white candle pattern. And the other rule is that the opening price of this candle has to be higher than the closing price of the previous candle at this point. So you have to see if you can identify a bullish gap, that's better. That's even better between the closing price here and the opening price here. And then if you have a long white candle, white or green, then you can say that, okay, the morning star is validated and we have a high probability of a reversal uptrend. You have a lot of other patterns. I will skip, I will not explain all the pattern because it will take too much time. You have the bullish engulfing pattern, as you can see in this example. This is also a very powerful reversal uptrend. Let me just show you some example in the market. Oops, sorry. So this is a chart of the JPY of the dollar yen. So the Japanese yen, the dollar against the Japanese yen, and you can see this formation on the candlestick pattern. This is what we call a downside gap 3 method. This one. So this is not a morning star pattern. This is a bit different, but this is another reversal uptrend pattern on the Japanese candlestick, which is called the downside gap 3 method. I have circled the pattern in red. So it can help you to anticipate reversal uptrend, because as you can see on this chart, the trend was down since, I will skip this one. So the trend here, the dotted line I just drawn on the chart, was down. So you have a bearish trend since the previous top hit in December 2016. And thanks to the validation, the formation of this pattern, you can anticipate a reversal uptrend. And you can also use other technical signals on the chart. For example, you can see that just after the validation of this reversal uptrend pattern on the Japanese candlestick, prices have escaped of what we call here a Browning bottom wedge formation. And so this is another bullish signal coming from this chart. So you have two bullish signals coming. The first one from the Japanese candlestick, thanks to the validation of the downside gap 3 method, and second one is the validation of the Browning bottom formation. So that's why that's very important to combine tools, to combine pattern and Japanese candlestick to fine-tune timing on markets, and it will help you to be more confident in the direction of the trend. So, for example, thanks to the breakout of the pattern, it was a very interesting buying point on the Japanese yen. So you can wait. When you can identify the reversal uptrend pattern on Japanese candlestick, maybe you can say, okay, either I want to take a risk and I can buy just after the validation of the downside gap 3 method, or you can say, okay, I will take less risk and I will wait for the validation of the Browning bottom pattern. And if the Browning bottom pattern is validated, I will be more confident to a further rise. So I will be more confident to buy when prices will have validated the pattern. So it depends on your risk management. If you want to take a risk, you can buy as soon as the Japanese candlestick is validated, or you can wait for the validation of the pattern, the confirmation. Okay, so let's switch now to technical indicators. So I will just show you an example on the RSI, because I think it's one of the most popular technical indicators, and that could be very interesting for you. So this is I will skip about this part regarding the formula, how the RSI is calculated. All you have to know is that we use a 14 period RSI on our charts. So when you have a look at our technical analysis on the newsletter that you receive on a daily basis, when you check the RSI, it is always a 14 period RSI, just for your information. So if you have your own software, you can find the same RSI by choosing the 14 period RSI. And we add a 9 period moving average on the RSI. Why? Because it helps you to fine-tune timing when the market is overbought or oversold. Because the most interesting, the most efficient way to use the RSI is when the RSI is overbought or oversold. When the RSI is between 30% and 70%, you cannot say a lot of things about the RSI. It doesn't give you a lot of information. However, when the RSI is overbought, so above 70% or oversold, so below 30%, then it can help you to fine-tune timing to take profit, or to fine-tune timing to open position in the counter trend. And especially thanks to the formation of what we call bullish or bearish divergence. So let's have a look at, for example, the euro dollar. I think because we had a very interesting, a beautiful bearish divergence on euro dollar in the past couple of weeks. As you can see here on my chart, I hope you can see it clearly. I will try to zoom in a little bit. Okay. So this is a chart of euro dollar. So what I wanted to show you is the RSI. Here you can see the RSI, and here you can see the price. So as I explained, the RSI is a 14 period RSI, and you can see the red line. The red line is a 9 moving average of the RSI, of the technical indicators. So what we call a bearish divergence? You can see that's quite simple. Have a look. Here, prices are making new high. So the pair is making new high. Everything is normal. We are in a bullish trend. At the same time, the RSI, the technical indicators, is making new high within the overbought area, so above 70%. So at this point, we cannot say a lot of things. We just can say, okay, the market is a bit overbought, but it's not enough to say that we will see a reversal downtrend. So, okay, the market is overbought, but we don't have, this is only a warning signal. Maybe we will see a consolidation phase, and that's what happened. A consolidation phase. The market was overbought, and prices, the pair has consolidated here, and the RSI have consolidated at the same time. So that's normal. But look at what happened here. Prices have rebounded from the bottom at around 1.16. Prices have rebounded, and prices have reached new high here. So you can see this point is higher than this point. However, on the technical indicators, so if you look at the RSI failed to make new high. So this point was lower than this point. And this point was around 70%, and this point was was clearly above 70%, around 75%. So the market was overbought. And this is what we call a bearish divergence. When the prices are making new high, but the RSI failed to make new high in comparison to the previous top. You can see these two areas. So at this stage, you can say, wow, we have a bearish divergence, but the divergence is not yet validated. So you have two possibilities. Either if you are already in position, you can say, okay, we have a bearish divergence. That's a warning signal. I would better to take my profit, but I would wait for the breakout of a technical element on the chart. For example, for this rising trend line. Sorry. So you can draw this trend line, and this trend line was a key bullish element. So you can say, as long as prices are holding above the trend line, there is no reason to be too much cautious, and I can keep my position. But as soon as prices have broken the trend line, clearly it was time to take profit and to close long position on euro dollar. Because at the same time, the RSI fell below 50%, so prices have validated the bearish divergence. So at this point, there was a high probability of a bearish acceleration on euro dollar towards the next support threshold around 1.16. This is the red line. So this is what we call a bearish divergence. And that's pretty easy and pretty interesting for you to use to avoid to trade in a counter trend of the current trend. So if prices are in an uptrend, you can wait for the breakout of a bullish element. It can be a rising trend line. In this example, it was a rising trend line, but it could have been a moving average, for example, or it could have been a bullish channel. There is a lot of technical element on the chart, but try to identify a bullish element on the chart, and then as soon as this technical element is broken, you can say that it's time to take profit, or at least it's not a good timing to buy the pair. So now, as you can see, prices are moving sideways between 1.16 and 1.20, and only a push above 1.20 would reinstate a bullish bias on euro dollar. So it means that since prices are broken below this trend line, prices are no more in a bullish trend. Prices are either in a sideways trend, as you can see here. We could be in a trending range between 1.16, 1.20, or we can be in a bearish trend, but we don't know yet. But we are no more in a bullish trend. And only a push above 1.20 would reinstate the bullish bias and would reinstate the bullish trend on euro dollar, since prices are broken below this trend line and the RSI has validated this divergence. So be careful. At the moment, on euro dollar, it's more sideways trading between 1.16 and 1.20. So if you remember at the beginning of this presentation, I said that the best trading strategies when you are in a consolidation phase, when you are in a sideways market, the best strategies is to sell the upper end of the range, so 1.20, and to buy the lower end of the range around 1.16, and wait for a breakout. As soon as we will see a breakout, either of 1.20 or 1.16, then we will be another indication of the trend, of the current trend. But at the moment, there is no more trend on euro dollar. This is sideways market between 1.16 and 1.20. Okay, just a word to conclude on the Bollinger Bands. Bollinger Bands are pretty, so very quickly, because we are approaching from the end of this webinar. Bollinger Bands are used, so the quick definition that consists of a middle band with two outer bands. So the middle band is a simple moving average, and the outer bands are usually set to standard deviation above and below the middle band. So how to use it? Well, the basic rule first is that according to the creator, which is John Bollinger, the bands should contain around 90% of price action. So that's very important. So most of the time, prices are between the upper and the lower Bollinger Bands. So the first way to use the Bollinger Bands is to sell the market when prices are above the upper Bollinger Bands and to buy the market when prices are below the lower Bollinger Bands. Because as you know, that 90% of price action has to be between the lower and the upper Bollinger Bands. There is a high probability that prices will post a rebound or post a consolidation around that area. So that's the first way to use Bollinger Bands. It can help you to identify excess on the market. So if you have the RSI, for example, which is highly overbought, and if you have prices which are above the upper Bollinger Band, you have a high probability of a consolidation phase. Another way to use Bollinger Bands is to use Bollinger Bands as a volatility breakout indicator. And that's, in my opinion, the best way to use Bollinger Bands. It's to use it as a volatility breakout indicators. Because when you have a consolidation, Bollinger Bands are narrowing. And when you have a breakout of Bollinger Bands, so Bollinger Bands are widening very quickly. It very often mean that you have a new trend have started. So a new uptrend if prices breaks above the upper Bollinger Bands, or a bearish trend if prices break below the lower end of the lower Bollinger Bands. So that's very important and very interesting to use. I'm not sure I have an example to show you on Bollinger Bands at the moment, maybe on a stock, but I'm not pretty sure I have this example in my software. But that's the idea. Let me have a look, maybe. Just to show you an example. Yeah, for example, here. So forget about the charts. This is a weekly chart, but forget about what is drawn. The area I would like to have a look at is this one. You see Bollinger Bands are narrowing here. And then here you have a bullish breakout above the upper Bollinger Bands. So Bollinger Bands are widening and you have a bullish breakout. What we call, if you remember the beginning of this presentation, this is typically a breakaway gap. So you have a breakaway gap above the upper Bollinger Bands, and Bollinger Bands are widening. So it means that a new uptrend may have started. And as you can see, prices are accelerating up very quickly just after the breakout of the upper Bollinger Bands. So this is another way to use Bollinger Bands as a volatility breakout indicators. But I will maybe come back on this in the forthcoming webinars. If we will do other webinars, I will take some time to explain exactly how to use these strategies on the market. This webinar was quite general, just to give you a general view on some of the most popular pattern and some of the most popular indicators on the market and the Japanese candlestick. So on the next webinar, we will explain how to set up a training plan and how to use Bollinger Band indicator, RSI indicator to fine-tune timing on the markets. So to conclude, I just would like to give you some books if you want to learn more, because of course, as I said, technical analysis, there is a wide range of principles, a wide range of technical tools. So there is a lot of things. and you can learn more by reading some books. For example, the John Murphy book. So this one, the first technical analysis of the financial market. That's one of the most popular book in technical analysis. I would really advise you to read this book if you like technical analysis, if you want to learn more, because it's very easy to read, and it will give you all the basic principle, the basic concept in technical analysis. So clearly that would be my recommendation for you, the John Murphy book. Then you can also have a look at the Bulkowski book, which is called Encyclopedia of Chart Pattern. This one is very interesting for backtesting pattern. Bulkowski has backtested a lot of patterns, so it can help you to identify which pattern are the most relevant, have the highest probability to reach their theoretical target. So that's also a very interesting book. Then you can also have a look at the candlestick charts by Clive Lambert if you want to learn more, if you like the candlestick, Japanese candlestick pattern. And also the Plummer, the Tony Plummer, which is a more generalist book, which is also interesting. Okay, so that's the end of this presentation. We can now have a look at your question. If you have some question, don't hesitate to ask me your question. So I can see that there is still there is question. So yeah, the use of the RSI is very interesting. To answer your question, you can definitely use it as a reversal trend indicators, as I explained, by using the concept of bullish or bearish divergence. So that's calculated from the price, of course, and so you can identify, thanks to the validation of this reversal signal, bullish or bearish divergence, you can identify reversal trend signal on the market. Okay, so thank you everyone. Thank you for participating to this webinar. And thank you for Orbex to have organized this webinar. And I hope we will do it again with maybe more specific subject, so we can speak about a lot of things in technical analysis, as you know. So if you have specific requests, please don't hesitate to go back to the guys at Orbex and to say, okay, we would like to have a specific subject on technical analysis, for example, on how to use Bollinger Bands, etc. Yes, the recording will be available, so you will have access to this just after this presentation. So thank you everyone, and see you soon. I hope it will help you to better understand the financial markets and to find interesting trading plan on the market. So happy trading everyone, and speak soon. Bye bye.